Who will win food tech's endgame? In January, Zomato acquired Uber Eats for an equity valuation of $350 million, giving Uber 10% of Zomato in return and driving a consolidation in food tech. History may not repeat itself, but it certainly rhymes. It thus certainly makes sense to study the history of India's fledgling food tech ecosystem. The foundations of the present state of food tech were set in the go-go days of 2015, when the number of startups funded exploded. 2015 is still the most well-funded series a year in Indian startup history, with $1.4 billion deployed in 540 investments. 2015 was also the year of hyperlocal investments. TinyOwl was the poster boy of India's new food tech ecosystem, raising $25 million over the year. At the time, there was a tiny company called Swiggy that raised a seed round of $2 million. Another giant company called Zomato was a unicorn. The rise of a duopoly. The ecosystem was bullish on the potential of disrupting food delivery. Imagine the ability to deliver anything to your doorstep in less than 30 minutes with a push of a button. Unfortunately, the optimism was not grounded in economic reality. Only two companies in the previous paragraph live today. The dead pool of hyperlocal startups was either used for acquisitions by large players, or simply laid to rest. The reason for pulling the plug was that hyperlocal delivery did not make sense at the ticket sizes, where the cost of delivery was itself equal to the order value. As we had observed earlier, most food tech startups, ironically, died because of indigestion. All the startups that raised an immense amount of capital expanded too quickly. In their quest to win the market, they tried to unsustainably acquire customers and suppliers. In their quest to eat, they ate too much. Swiggy, on the other hand, did it slowly and sustainably. Starting with only Bengaluru, it took a year before expanding to other cities. Perhaps tempered by the food tech disasters, Swiggy focused on not eating too much too quickly. A lesson you must keep from here is, history certainly rhymes, as you will see later. Less than 5 years ago, the way Indians consumed food was completely different. Eating out was predominantly occasion-driven, while ordering food was limited to calling local restaurants or ordering a pizza from Pizza Hut through their own websites. Online food ordering through apps was not a part of consumers' culinary vocabulary. However, this has been transforming over the past few years. Today, Indian consumers, especially in metro and larger cities, are ordering food online more often than before. As a result of this, food tech has become one of the fastest-growing internet sectors in India, with an astonishing triple-digit growth rate in gross merchandise value (GMV) in 2017 and 2018. The food tech market, comprising of tech-enabled delivery, grew from $300 million of GMV in 2016 to more than $4 billion in 2020, more than 100% each year. An average customer places an order at least 3 to 4 times a month, with the frequency of ordering expanding to breakfast and snacks beyond lunch and dinner. Non-metro cities grew 7x faster as compared to metro cities in the last year. Daily order volumes grew 4x from 370K in 2017 to 3M+ in 2019. Food tech's Captain Marvel of growth was Swiggy, of course. As the pioneer of scalably delivering food on time to your doorstep, Swiggy was followed by Zomato. Zomato, although worth $1 billion to Swiggy's $10 million in 2016, was smaller than Swiggy. Seeing Swiggy's rapid scale, and Zomato follow, cab aggregators turned their wheels. Failing delivery men in black. India's cab-hailing aggregators' entry in 2017 was strategic. Ola acquired Foodpanda in DEC 2017 with plans to invest a further $200 million, while Uber launched Uber Eats in May 2017. It may seem like a random bet to monetize users, but the rapid scale of food tech's daily transactions compelled the ride-hailing companies to add another rapidly growing daily transaction feature. If we see the entry of Uber and Ola in late 2017, you can see that food tech was beginning to show signs of an increase in pace. While daily volumes in ride-hailing was 18.5x those of food tech in *17, the gap narrowed and reversed over the past 2 years, with food tech becoming 1.4x of ride-hailing in daily volumes. Uber Eats entered the market when the two incumbents had already gained significant mind share and was disadvantaged from being a late entrant. Unless it had a radically different strategy from the existing players competing in the tightly fought market, did not make much sense. Lack of differentiation in communication and branding strategy did not help further. It appointed one of the best actresses in Bollywood and tried to woo the millennials, but the incumbents were still ahead with quirky campaigns. Price sensitivity and order frequency coupled with the size of the consumer segment determines the pricing strategy of the food tech players. Newer players typically target the price-sensitive cohort, which are alternate users and deal hunters. This is due to their weak brand loyalty and lure them through promotions and discounts to gain market share. Discounts of 20 to 50% are prevalent in the market, and it becomes a real challenge for the food tech startups to then differentiate or create a strong loyal base. Uber Eats targeted the first two cohorts, deploying a deep discounting strategy. This led to rapid growth in user base, which would switch to other apps if they did not find the best deals discounts on Uber Eats. Uber's lackluster IPO resulted in the parent entity realizing that it was a significant drag on margins which Uber Eats India business had. Uber had to clearly let go of this business and let go fast. But what was the reason for letting go of what could be a lucrative business in a massively growing market? Unit economics and indigestion, or history rhyming with itself. The eternal problem of unit economics. The problem of low average order value and repeat remains the biggest challenge in India. India is at 1/10 of developed markets. A typical order in the US is for $20, $30, 1,400 Indian rupees to 2,100. It is possible to make a positive contribution margin on an order. While developed markets see 40 to 50 meals ordered per month, Indians order food less than 5 times a month. Expansion to Tier 2,3 markets is also challenging, with the risk of order value depressing further while the cost structure for delivery remains the same. By 2019, the food tech companies would only see some lead in their unit economics. On an order of $4.50, a food tech company would on average make just 40 cents, or 7% of the average order value. For the 400 plus orders every year that Swiggy was doing, it was left with just $160, 0.4 times 400, for financing its internal operations. Uber Eats, with 1/4 the orders, was burning $9 every month, or $100 a year when it was generating just $20 in post-delivery. The cost structure makes it clear that streamlining logistics to reduce delivery cost is the key to improve unit economics than a greater focus on convenience or restaurant delivery for the users. Volume has been driven through an addictive hook of discounts and cashbacks which needs to be curtailed, and users need to be rationalized. Zomato has been trying to streamline logistics and reduce burn. Zomato's CEO remarked in 2019 that per order it loses 25 Indian rupees now compared to 44 Indian rupees in March 18. Its last mile cost per delivery has also gradually reduced from 86 Indian rupees to 65 Indian rupees now. The economics are being reflected now as it cut its cash burn to $20 million per month in October 19 compared to $45 million per month in March 19. Thor's economical cloud kitchens. Cloud kitchens appear to be the next big land grab for better economics. Cloud kitchens allow delivery companies to make more margin than just aggregating. Similar to Amazon doing a white label of products, the food delivery players are white labeling food. Food tech players hope this is the hammer to break the unsustainable economics. Like in delivery, where Swiggy moved first, the Swiggy Access program appears to be working best. Its big bet on Cloud Kitchen has played out well. As of November 2019, it had established 1K Cloud Kitchens for its restaurant partners, more than any of its rivals. In the long run, Swiggy targets to have 20 to 25% of its orders from these delivery-only access kitchens. An erstwhile food delivery startup, Fossos, is now a full-fledged cloud kitchen player. As we had elaborated in our piece earlier, cloud kitchens would be the brands to the retailers that Swiggy/Zomato were. The scalability of cloud kitchens coupled with attractive margins could help improve the economics of food delivery players. Facing off in an infinity war of capital, as we talked about earlier in the piece, Uber Eats' exit from the country through a sale to Zomato is food tech's biggest news today. For Zomato, their orders per month will rise by 10 million from 38 million it was clocking, putting it above Swiggy, which receives around 40 million in monthly orders. Both Swiggy and Zomato have a presence in 550 cities, but their markets are different. Zomato is strong in the north, which accounts for almost 70% of the 36 million orders it gets in a month, company sources said. It is the other way around for Swiggy, with the south contributing to about 70% of the 42 to 45 million orders it services in a month. But while the new duopoly suddenly finds themselves as the two standing after a bloodbath, a dark cloud is hovering. The Thanos of food tech's endgame is Amazon. Amazon could make food delivery another feature of its vast array of services. You may wonder why this makes any sense, especially in the backdrop of two ride-hailing giants trying to add food delivery as a feature and failing. Indeed, the worry of a large giant coming and disrupting an upstart is usually misplaced because of the deep market understanding needed to scale. But that is before you see how close Amazon is to Swiggy/Zomato, and how far Ola and Uber were. At a superficial level, Ola/Uber had mastered the art of moving four-wheelers while Swiggy/Zomato primarily run a two-wheeler movement business. Digging deeper, you realize that you only care about what happens during transit. You don't really care too much about which car you're getting as long as it's there quickly, and Uber/Ola don't really care about what you do after you get off the car. Swiggy/Zomato on the other hand, need to solve for the before and after really well. The food tech players need to provide you with a well-curated range of food brands to browse through and discover. You mention to them your food requirements and specifications, and they should care about how the food is experienced. The food needs to be packaged well and delivered on time. If the food is bad, or a specification you gave was missed, you're likely to be immensely frustrated at Swiggy/Zomato. Most importantly, Swiggy/Zomato deliver food from one fixed location, food brand, to another fixed location, home. Replace Swiggy/Zomato with Amazon and food with product, and you can see why Amazon could snap its fingers and turn on food delivery as a feature. As you recollect, most of the margin in every order is spent on delivery. The company that simply has the most efficient delivery infrastructure in the country today is Amazon. Personally, Amazon has more touch points per week than any other internet company. With $40 billion of e-commerce sales, and assuming a high order value of $10, 4 billion orders are delivered every year, or 15 million orders every day. Assuming Amazon has 50% of these, Amazon is delivering 8 million orders every day, of incredible complexity to more PIN codes than Swiggy/Zomato. Its $20 billion GMV is 5x of food tech's entire GMV. In a few years, Swiggy/Zomato may not be a duopoly, but consolidating to fight a monopoly called Amazon. Whether this story plays out like Marvel's Cinematic Universe or turns out to be a Thanos-dominated alternate universe remains to be seen. But the consolidation is definitely not over. The winner of food tech's endgame may not be Swiggy or Zomato, but Amazon. Source of this video is juniorvc.com. Please do check out the website for such interesting articles on tech and business.